What if I told you the single biggest financial move of your life, the one everyone says is the path to stability, is actually the thing keeping you broke? Stop for a moment and picture this. You're standing in your beautiful new kitchen. It's got granite countertops, the perfect backyard, the two-car garage. On paper, you're winning. You own a major asset. But in reality, you just checked your bank balance, and the number is terrifyingly low. That pit in your stomach? That's the reality of being house poor. You have a valuable house, but you have zero financial life. This isn't just about a high mortgage. This is a silent financial trap that has locked millions of successful Americans into a life of constant, suffocating anxiety. Right now, over 30% of new American homeowners are spending half their monthly paycheck just on their housing payments. They are surviving, not thriving. If you feel trapped, you need to know why, and more importantly, how to break free. The traditional American dream is built on the foundation of homeownership. And for decades, the math worked. Your parents likely told you that renting is throwing money away and owning is building wealth. It was the absolute truth. But the math has changed radically. According to recent data, the median price of a home in the U.S. has soared past $400,000, while wage growth has lagged far behind. This means that to get into the market, people are making bigger and bigger compromises. Lenders will approve you for that huge loan because they can often pushing your debt-to-income ratio to its absolute limit. But the maximum a bank will lend you is not what you can actually afford. They're not factoring in the reality of your life, your stress, or your future. They're not accounting for the hidden costs that crush your financial life, the property taxes that seem to rise every year, the homeowner's insurance that is no longer cheap, and the HOA fees that feel like throwing money into a black hole. And that's before the real killer arrives, maintenance and repairs. When you rent, a burst pipe is the landlord's problem. When you own, that $5,000 emergency plumbing bill is yours. The roof needs replacement? That's $15,000 out of your pocket. The vac system dies. Another $10,000 to $12,000. These are facts of homeownership. The average homeowner should be setting aside over $500 a month for expected maintenance, but when you rehouse poor, you're setting aside nothing. Every unexpected bill feels like a punch in the gut, forcing you to rack up credit card debt, instantly canceling out any equity you thought you were building. But the cost of being house poor goes far beyond the balance sheet. It takes a wrecking ball to your freedom and your potential. Imagine this scenario. You have an opportunity to leave a toxic job for a higher paying one, but it requires 6 months of training with a slightly lower starting salary. If you're house poor, you are paralyzed. You can't afford even a temporary dip in income because your entire paycheck is allocated to the mortgage. This is the Golden Handcuffs effect. You are locked in, emotionally and financially stagnant. Your employer knows you can't leave, and your career progression stagnates. Contrast that with someone who rented a modest apartment and, every month, invested the difference of that high mortgage payment. They have the financial cushion and the freedom to walk away from a bad boss, take time to pursue a certification, or start their own business. They have options. You have a 30-year liability that dictates your career choices. This leads us to the biggest opportunity cost of all, compound interest. The house-poor homeowner has effectively $0 left over at the end of the month to invest in the market. They are missing out on decades of powerful compound growth. If you're finding this helpful and you want to build a truly wealthy future, subscribe to Finance Flash right now. Let's do a quick comparison over 20 years. Homeowner A, house poor, buys a $400,000 home, stretches budget, has $0 to invest monthly. Their home is worth $600,000 in 20 years, but they have $50,000 in credit card debt from repairs. Net liquid wealth minimal. Renter, investor B, financially sound, rents for $1,500 month instead of the $2,500 mortgage tax payment. They invest the $1,000 difference every month. After 20 years with an average 8% return, that difference has grown into over $500,000 in liquid investments. Net liquid wealth, $500,000 plus. See the power of that choice? You can't eat equity? You can sell your house every time you need cash for an emergency without displacing your life. The person with the $500,000 in liquid investments is, functionally, the wealthier and more secure person. This is the crucial insight: your house should be a tool that serves your life, not a master that owns your life. So, what do? If you are sitting in a house that feels like a prison, you need an actionable strategy. The way out: actionable steps: acknowledge and audit. Stop denying the stress. Be ruthless. Find out where every dollar is actually going. Track your spending for 1 month. You will likely find hundreds of dollars in subscriptions, unused memberships, or discretionary spending that can be immediately cut to create cash flow. Build a cash cushion fast. Before you pay down more principal, you need a substantial emergency fund. This is your safety net against the inevitable major repair. Aim for at least $10,000 to start. This buffer completely changes the way you sleep at night. Optimize housing costs. Look into refinancing if current interest rates are lower than your mortgage rate. Even a 0.5% drop can save you hundreds a month. Can you rent out a room or a basement apartment for extra income? This income stream can turn a crushing liability into a manageable asset. Define your financial North Star. Before you make any major financial decision, especially buying a house, you must define a budget that leaves ample room for saving, investing, and living. The house is part of your life, but it cannot be your whole life. If you are thinking about buying soon, internalize this advice: do not buy the most expensive house the bank will approve you for. That is the path to being house poor. A smarter, safer goal is to buy a home that costs 2.5 to 3 times your annual income maximum. Factor in all costs: the principal, interest, taxes, insurance, and $500 a month for maintenance. If you can't comfortably fit that full number into your budget while still saving and investing, you can't afford the house. Build up a larger down payment aim for that 20% to avoid PMI, lower your monthly payment, and give yourself a substantial cushion. Waiting an extra 2 years to save $40,000 is a better financial move than leaping into a house that leaves you stressed and bankrupt for the next 2 decades. The goal of homeownership is to build wealth and stability, not to trade one kind of financial anxiety for another. Your home should be a foundation for freedom, not a prison for your finances. Choose the house that lets you sleep at night, save aggressively, and build the future you actually want. That's what real financial success looks like.